business owner is going to have a net profit of $100,000 and their bank account does not reflect that. It's a smaller amount and it's causing them crazy. And we are here to tell you that if you have felt that way, you're not insane, you're not crazy.
It's extremely common across almost most of the businesses that I have a meeting with. And it's usually the first sign that something important isn't visible yet
Mm.
because profit and stability are not the same thing.
Hello there, Salim Omar here from Straight Talk CPAs, and I'm joined today in this episode with Abhi. He's an accounting advisor and CFO at Straight Talk CPAs. Abhi, welcome.
Thank you, Salim. It's so nice to be here.
So
So,
you said profit and stability are not the same thing. Tell us more. What do you mean by that?
most business owners are taught to focus on profits, and
Mm.
profit matters, but profit is accounting logic. Cash is the survival reality of that business. So, in simple terms, profit is a calculation, but cash is oxygen.
Profit is a calculation, cash is oxygen. I like that. We see profitable businesses, they still feel very tight on their cash position for very real reasons, right? Things that they did in the business that made sense to do, but that's the reason why cash went down. For example, they paid down debt. Yeah, they had perhaps a line of credit or they had a loan and they wanted to pay that down. It takes cash. So the cash went from the bank account to paying and reducing the debt, or they bought equipment, or their inventory, or they took owner distributions, or cash is sometimes, Abhi, we see it's tied up in timing gaps.
And none of those are any mistakes on part of those businesses, but they still consume cash. And profit does not warn you when that is happening in that business.
That's the illusion, isn't it? The numbers say you're doing well, but the body feels
Yeah.
the stress. You're looking at the net profit like, wow, I made $100,000 profit, $50,000 profit, $200,000 profit. Something's not right because cash is the oxygen, as you said earlier, and
Yes.
you're out of oxygen or you're low on oxygen.
This is where business owners confuse profitability with stability.
Mm.
Stability isn't just profit, it's predictability. In simple terms, stability means revenue arriving when you expect it to be, or expenses stay within reasonable bounds, and you have enough cash to operate calmly.
Not optimistically, but calmly. You're being realistic, but you remain calm because you know the business is stable. Revenue's coming in when you expect it to come in, and the amount you're expecting is coming in as well. So if you're budgeting, all right, I'm going to bring in $500,000 in this next quarter. It comes in when you expect it, and then expenses stay within the budgeted amounts.
Will sometimes reference to concepts like quick ratio, but not as a formula. It's simple
Mm.
intuition. If you can't comfortably cover the next 30 to 60 days of obligations, you are not stable. Even if on a yearly basis you are profitable, you
Mm.
could be projecting a $200,000 profit next quarter and still feel constraint and pressure on a constant basis. That's not a contradiction. It's just a visibility issue.
And one of the things that I've seen a lot in my career working with business owners, it's I think one of the biggest blind spots in a small business is cash timing. So here's what cash timing looks like. If your vendors are net 10, so you're getting invoices and it says net 10 at the bottom of that invoice, meaning you've got to pay that invoice within 10 days. But your customers, your clients, if they're paying you net 30, then what's happening is the business is floating 20 days. That's where the business has to cover between money coming in and money going out.
And that gap of 20 days doesn't show up clearly in an income statement or a profit and loss statement that you would say,
Mm.
but you feel it each and every week for the entire year.
So this is a tool we like to use. It's a 13-week cash projection because it's eye-opening, not because it's fancy, but it's for the first time when we show this and create this for the business owner. They see the gap, and once they see it, the stress starts to make sense.
And I would say another reason businesses feel unstable is that financial reports don't show pressure points. They don't show the stress of paying out payroll or the
Mm.
hesitation before paying any expense and wondering how much you can safely pay yourself.
It doesn't show the fragility, right? For
Yeah.
example, having one critical vendor, yeah, that risk doesn't appear anywhere in the financials. So, I mean, financials are, they've got limitation.
Financials can look clean while the business
Mm.
feels fragile.
Yeah, you can have a amazing, beautiful looking financial numbers look good from a P&L standpoint, revenues, profits, and yet the business does not feel stable. It affects the owner because they don't, when say business is not stable, it's affecting them and their stress and their frustration. Most owners, they're looking at the financials monthly or quarterly, some at the year end. But by the time they're looking at them, the decisions have already happened. It's like steering a car by looking at the rear view mirror. Yeah, you're technically informed, but directionally you're blind. This is where we start shifting business owners away from pure reporting, not towards more numbers, but towards clearer signals. Simple, forward looking scorecards, ideally reviewed weekly. Not accounting tools, these are clarity tools. We use this, we have our our team meetings every week, and we're looking at scorecards. And they've become such an important part of looking at these numbers, forward looking numbers that
Mhm.
actually tell us what's going on and what we
Hmm.
should do next week, right? In the business. What changes do we need to make, if any?
Exactly, yes. The thing about scorecards is you can't standardize those across industries or
Mm,
key functions. That would be different for each company or each industry.
mhm,
KPIs of that scorecard would be different. What's working for us as a CPA firm wouldn't work the same way for a software company or a manufacturing company. Here are some
mm,
general
mm.
examples of those KPIs. Let's say for sales and marketing, some of the
Yeah.
KPIs would be the number of leads generated during that year, conversion ratio, what's the average deal size during this year, and we compare it to what's currently happening during that day and that
Mm,
deal. We have
mm.
a live comparison.
Yeah, I like what you shared there that KPIs, key performance indicators, these are the things that you're measuring within the scorecard. They can vary. I like to really think of the best KPIs are the ones that are built internally. It's like, all right, what do we need to know? I think asking this question is what do we need to know as a business so that we can steer this business in the best way possible, right? So that's the leadership team, the business owner asking what numbers do they need, and if they've got their team, then they are having this conversation with their team, perhaps doing it by functions of the business, like sales and marketing. You mentioned that. What are the key performance indicators that we need to know, say, for producing the product, the client, the service, depending on the business, right? What are some of the things? Maybe it's like revenue per employee, maybe it's that, or maybe it's gross margin, or maybe it's utilization rate. Yeah, internally generating is, I think, the best way to be doing that for that business. What are the numbers the business needs to know so that they can operate in the best way possible?
And if you would say in terms of operations or cash, those would be something like what are the accounts receivable aging or the number
Mm,
of days that you receive your money from your customers. What are the number of days that you pay your
mm,
vendors? Or what's the net cash inflow, outflow, how much during that
mm,
particular week? Or the quick ratio? Is it
mm.
being constant throughout each and every week? Is the change very minimal or is the change very big from one week to another? Just enough clarity to stop guessing.
When visibility is low, owners start second guessing everything. Yeah, they're really relying on gut feeling, instincts, gut feeling. And I'm totally for that. I think there's a lot to be said about having a gut feeling. But imagine
Yeah.
having this gut feeling plus having data that goes beyond financial reports, the typical financial reports like profit and loss and all that. That's one part of it. It's an important
Mhm.
part of it. But if you really want to go kind of forward looking, then some of this stuff that we're talking about in terms of having a scorecard and key performance indicators, that's when the confidence, the business owner starts feeling having that confidence, and
Mhm.
decisions feel lighter when they're equipped. Anxiety goes lower because you've got that clarity and visibility.
Yeah, your gut feeling has a strong backing through these numbers that we just mentioned. And if you don't have those backing, and over time, that chaos in mind would become normal. Stress becomes the baseline of any business transaction. And the hardest part is most owners think this is just how business feels. It isn't. It's just that you have a visibility problem. That's we can conclude with.
Yeah, I mean, and really, the theme of this episode is why profitable businesses still feel financially unstable. It's a profitable business, but it's more the visibility. This was great, Abhi. Appreciate you sharing this, and looking forward to the our next conversation.
Thank you. Likewise.